Hey everyone, welcome back to Corporate Dakota. Today we're diving into Saratoga Investment Corp's latest quarterly report. It's like peering into the engine room of a ship to see if it's running smoothly or about to blow a gasket. Except instead of steam, we're dealing with dollars and debts. Let's find out if their investment strategy is keeping them afloat or if they're navigating into troubled waters. This report shows Saratoga's finances for the period ending May 31, 2025. So everything we discuss is based on their performance up to that point. But first, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below, so feel free to join for more discussions and insights. This document is a Form 10Q filing with the Securities and Exchange Commission. It's a quarterly report that publicly traded companies in the US must file, giving investors a snapshot of their financial health and activities. We're looking at Saratoga Investment Corp's report, so it's their way of telling everyone how they did over the last 3 months. Let's get started. First up, let's take a look at their balance sheet, like understanding how much they owned versus how much they owed at this period. We'll focus on a few key numbers here. Their total investments at fair value, basically what their investments are currently worth, were about $968.3 million. That's down from $978.1 million decrease in its investment value. Next, they had about $131.6 million in cash and cash equivalents. This is up from the $148.2 million from last quarter. That helps them make new investments or handle unexpected financial needs. On the liability side, revolving credit facilities which act like company credit cards came in at $70 million. That's a noticeable jump from $52.5 million back in February. This tells us that they are likely borrowing more. They also have various notes payable, including $17.5 million in 4.375% notes due in 26, meaning they are borrowing at 4.375% interest rate and should repay it by 2026, and many other debt. Overall, we're seeing a company with large investment holdings, healthy cash reserves, but increasing debt. Now let's move on to their profit and loss statement. Time to find out if they are actually making money, so we have to analyze some key data here. First, their bread and butter is the total investment income for the 3 months ended May 31. 2025, it was $32.3 million, down from $38.7 million the same time last year. To simplify, that means they made less money than last year using investment activities. Doesn't sound too good. Next, total operating expenses were $22.2 million compared to $24.3 million last year. This means their expenses were a little lower, which is a good sign. The net profit is their net investment income, which ended up at $10.1 million, considerably down from $14.3 million the same time last year. It means they are making less money from their operations. Finally, for the realized and unrealized gain loss on investments, which shows here $3.8 million this year versus a loss of $7.7 million last year. So at least this year, Saratoga didn't make a loss from their investments. This also indicates they didn't sell off a lot of investments this quarter, or they really believe that their value is still there. The all-in weighted average earnings results in $0.91 from $0.48 last year. Seems positive, but they have less shares outstanding, making it easier to increase that number. Next stop, how cash is moving in and out of the business in their cash flow statement. Let's start by the cash provided by used in OCITs, which are the bread and butter of the business, in this case $32.3 million, which means from the main company operations, Saratoga has increased its cash reserve. That's compared to generating $50.15 million last year. It's a big decrease in cash flow generated. Let's explore net cash provided feeds in. Financing activities. It's using almost $13 million in financing activities compared to generating almost $1 million last year. It's a big swing and worth taking a look into more details. Looking at what makes up the financing cash flow, we can see that they have borrowings on debt of $17.5 million, which is typical. They have repayments of notes of $20 million, which explains the change. This can be generally viewed as the company working to repay their senior securities, which has pros and cons. Proceeds from issuance of common stock generated $6.14 million to the company's treasury compared to $0 last year. Diluting shareholders might hurt the company's shares prices if they continue to do this. Finally, Payments of cash dividends totaled $16.7 million, compared to almost $9 million. The numbers can be seen as quite significant. The main difference that contributes to the cash flow statement. This all in all contributed to negative $13 million cash flow in that quarter. Original acquisition cow for Datesel. Scorecare Kax's dates kite all. Showed here is an extensive table showcasing individual investments within Saratoga's portfolio with details on industry, interest rates, acquisition dates, principal cost, fair values, and percentages of net assets. This is a great way to gauge their risk and diversification, but we'll just highlight some key topics here. Their investments are heavily weighted towards non-control, non-affiliate, which is not necessarily positive and need to be analysed further individually. Here's where money flows in and out. It's a pretty diversified portfolio across many small companies in industry such as alternative investment management software, architecture, associations, customer services, and many more. So there are plenty of different ways to look into this. For example, Artemis Wax Corp seems like a huge part of the portfolio. However, some parts are not looking too well, such as TG Pressure Washing Holdings, valued at $0, or can be doing well, such as Maple Holdings, valued with a good unrealized value toilets. Lots of these details are hard to gauge, however, worth pointing out here is that around 13% of their assets are in affiliated investments. These are risky since a good portion of company revenue comes from companies related to them. Should these companies go under, their revenue can suffer really hard. Same risk goes for the controlled investments. A large part of Saratoga's investment are correlated to the performance of their controlled investments. Here we have a similar schedule, but for February. We'll analyze those investments as a whole later. As of May, Saratoga has roughly $106 million in off-balance sheet obligations in terms of commitments, with around $78 million subject for approval. It's also high compared to their cash reserve of roughly $92 million. They need to be extremely careful to manage these or risks defaulting on loans that might require them soon. Now that we've dissected most of the report, here's my take. Saratoga is in a stage of transition. While they show the ability to increase their share price and grow operations, revenue decrease does not show a sign of a healthy business. What's more, Saratoga needs to manage their risk as they shift from their previous portfolio of BDCs. Their debt level seems healthy and doesn't appear to hurt its overall bottom line. However, given their cash reserves, they are definitely stretching themselves a little too thin. All things considered, what they have right now is not too terrible and not too great. Alright, that's our breakdown of Saratoga Investment Corp's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.